On May 19, 2005, Michael Burry bought his first credit default swaps in anticipation of the housing crisis. $60 million of credit default swaps from Deutsche Bank, $10 million each on 6 different bonds. His prediction was the U.S. mortgage-backed security, once a stable, respectable investment product, had slowly turned into a dangerous and deceptive time bomb. This bet was no gamble. He did the digging, he read the documents, he knew this would take the rest of the world another 2 years to even start looking into, and it took until the 11th of October 2007 for the S&P 500 to top out at 1,576 points. A year and a half later, on the 10th of March 2009, the S&P closed at just 676 points, a 57 crash. Michael Burry ended up making a personal profit of $100 million and made his investors over $700 million from this single bet. In the years leading up to this amazing success, he received constant criticism from the investing world and even his own investors that ultimately led him to close his fund. So this happened 15 years ago, and the reason we're telling you this is that history is currently repeating itself. The first one to see that there was something seriously amiss in the mortgage market was Dr. Michael Burry. It was back in February of last year that Michael Burry first warned of high inflation as a consequence of the Fed's unprecedented money printing. He was tweeting to prepare for inflation, hashtagging doom to repeat, and called out the U.S. government and the Federal Reserve over the trillions of dollars worth of stimulus they'd done. At this point, the Fed was printing money, yes, but inflation was staying low. At the time, the latest published data showed an annual inflation rate of just 1.7. That's lower than the Fed's target, but Burry knew that, as always. We're now running at a red-hot inflation rate of 8.6. Interestingly, in the past month or so, Michael Burry hasn't just been doing victory laps. Instead, he's been tweeting quite extensively explaining why he believes this economic crisis and subsequent market downturn has only just begun and the worst is yet to come. He also thinks the S&P 500 could lose another 50 from where it sits today. We've seen over the past 25 years the bottom of a current market crash, which is usually lower than the one that came before it by about 10 to 15. Adding that 15 below the S&P 500 low that we saw in 2020 takes us down to 1,862 points. That's crazy because it shows that Michael Burry's anticipating a peak to trough fall of 61.4, which would bring us back down to the historical normal Shiller P of roughly 16. Essentially, from where we are today, Michael Burry anticipates a further 50+% drop-off in the stock market. It's a bold prediction, and it's a prediction that was once again met with criticism, as over the past few weeks we saw the market bounce 6.5%. However, as we've seen even just across the past few days, short-term bounces certainly don't mean we're out of the woods. Michael Burry recently tweeted that even during the worst times, statistics show that it's actually quite common to see strong short-term recoveries among the longer-term downward trend. Burry certainly seems confident that we're simply in the early stages of a much bigger problem, and to further his point, he also took the time to comment on the comparatively low trading volumes we've seen during the 2022 downturn. He said, top to bottom, Microsoft traded 5.2 times shares outstanding by 2002, 3.3 times by 2009, and 0.5 times so far. Amazon traded 5.7 times by 2002, 6.6 times by 2009, and 0.9 times so far. JP Morgan traded 3 times by 2002, 5.9 times by 2009, and about 0.7 times so far, etc. So when you look at the trading volumes, even though we've seen the market cool down, you know quite a bit in 2022, and everyone seems bearish. From what you hear, the selling really hasn't even started. So in Burry's opinion, we're likely going to see a lot more selling volume coming over the next few years, which would lead to much larger declines in the stock market, and it's a scenario that he said he's not looking forward to. The interesting thing to remember with Michael Burry is he's seen this happen all before, the first time through the dot-com bubble, the second time in 2008. He's seen these repetitive patterns of human behavior time and time again. He's studied the greed and the excess of the major booms and busts, and that's what gives him such confidence when he talks and tweets about these issues. He recently posted a chart to his Twitter which was quite eye-opening. In that chart is the 10-year S&P 500 run up to today, the run up to the dot-com bubble, and the run up before the Great Depression. It's pretty scary how similar they are, and Michael Burry comments on this saying, "Third time's a charm." You gotta love human nature. Nothing if not consistent. You see, for him, he's seen this pattern of human behavior many times before, and he understands where it leads. It was only 12 months back that he was tweeting that he saw the greatest speculative bubble of all time in all things by 2 orders of magnitude. Perhaps now in his eyes, it's been pushed to its breaking point. But of course, this is all just the stock market. We have to remember the core reasoning behind Burry's point of view is, of course, the economy. Now, we already know Burry's thoughts on inflation, and yes, we are seeing the Fed raise interest rates to make borrowing harder for businesses, but we have to remember that interest rate rises also affect the fundamental building blocks of the economy. Unfortunately, consumers have less money to spend because more of their savings and income go to servicing their debts. This very frequently starts a negative spiral because less discretionary spending means less sales for the companies that we're investing in, so ideally you want the consumer to be raking it in. However, recently, Burry's been hinting that consumers aren't doing too well right now. Personal savings fell to 2013 levels, the savings rate to 2008 levels, while revolving credit card debt grew at a record-setting pace back to pre-COVID peak. Despite all those, trillions of cash drops in their lap, looming a consumer recession and more earnings trouble. So Burry's quite clearly worried about the depletion of savings, not just because it's pushing everyday people to use more credit cards in an environment of rising interest rates, but also because lowering of savings equals less spending, which hosts the bottom line of these businesses that we're invested in. One anecdotal piece of evidence that Burry referred to recently was Amazon's Q1 results. As CNBC wrote, revenue at Amazon increased 7 during the first quarter, compared with 44 expansion in the year-ago period. It marks the slowest rate for any quarter since the dot-com bust in 2001, and the second straight period of single-digit growth. Burry responded by saying, "So Amazon says to GDP, there's your weakening consumer. The savings are covering less and less of America's GDP at a point where America's GDP is shrinking." So overall, in Burry's eyes, we have inflation, interest rate hikes, reduction in consumer savings, thus less discretionary spending, which ultimately leads to lower profitability of businesses. We've seen thus far re-ratings on their stock, and in Burry's view, we're only in the first inning. It's a very interesting topic to explore. Michael Burry's thoughts are extremely bearish, but do you think he's maybe missing a mark? Let us know about your view on Michael Burry's analysis in the comments section. Thanks for watching.